So, yes, hi everyone. This might be your very first CA final class. You might be very excited, of course, because you are starting your CA final classes. But then, guys, remember you cannot let your excitement die in a couple of days. We are starting off with a paper like Strategic Financial Management, which will always keep you on your toes. This is a practical paper with a little bit of theory. You will have to attempt theory of 20 marks in the examination. I will come to the question paper pattern in some time. But always remember, guys, you do not accumulate wealth in stock markets overnight. Likewise, beta, you will not succeed in anything in your life just by working for a day. You are allocating 3 hours of your precious time every day to these classes. Ensure that you make the most of it. Ensure that they are very productive. Ensure that you're very efficient, effective during these classes. If you are effective, guys, if you're effectively listening to the classes, you're understanding everything during the classes, almost 80% of your preparation will be done during the classes only. It is not like you will have time to do each subject twice or do classes for each subject twice before your examination leave. Most of you guys are writing in November 2023. A couple of you are also writing in November 2022. So irrespective of your attempt, let it be May 2022, November 2022, May 2023, November 2023, you will have to put in the effort. Ensure that over the next 75-80 days you will have classes, approximately 75 classes, guys. So ensure that you are giving your 100%. If there's a homework question given, take out 15-20 minutes of your precious time, solve the homework question. Every now and then, guys, if you are getting time, do revise. Once the entire subject is over, you can solve the subsequent question papers. You can solve the subsequent RTPs that are rolled out by ICAI for your practice. Now everything till the previous attempt, July 2021, will be covered in the materials. Your study material of ICAI, all the mock test papers, all the revision test papers, all the question papers, including the RTP of November 2021, because that has already been rolled out. So all of this will already be covered in your material. But the subsequent question papers can be considered as practice papers. You can always solve those question papers so that you remain in touch with the subject as well. And it is for your practice. It is for you to realize how much effort will you be required to put in before the main examination. So that will be like a good practice. Also, if there are any new concepts, if there are any new questions that are rolled out in the subsequent question papers, or if the ICI is adding any new questions, any new concepts in their study mat, we will be covering it up later separately. ऐसा सोच के ही चलना बेटा that you will be needing approximately 5 to 10 hours on a later date again. Even after all the classes are done, whenever your attempt is better, you might need additional 5 to 10 hours for those additional questions. It is not like you will see the questions that come in the examination are all entirely new. Most of the question papers, guys, SFM, you will see that the questions are repeated with 1 or 2 new points that generally come in the exam. But usually, guys, the questions are all repeated, except for November 2020 and Jan 2021 papers, which are very interesting. Otherwise, but usually the questions are similar. Now, during our classes, guys, I will be giving you a lot of time to read the question on your own, to understand the question. Remember, problem solving is very easy. The solution to any question is very, very simple. What is difficult is only understanding the question properly. Not every question, most of the questions would be straightforward. But then if a new question comes in the examination, 80% of your job is done if you understand the question properly. For that, you cannot directly start reading the questions in the exam. You will have to start practicing that now itself and not on a later date. Okay. So if I am giving you time now to read the question, utilize it. If I tell you that you're supposed to solve the question on your own, I will wait for 5 minutes. Try solving the question paper. Doesn't matter whether you're making a mistake, whether you make hundreds of mistakes or thousands of mistakes. Remember, it is only practice. It is not that we are going to write the examination today. We are going to write the examination after a year or after 2 years. So yes, it is very important that when I give you time to read the question, you properly utilize that time. You actually read the question and do not just while away time, guys. That is how you will ensure that your 3 hours are very, very effective. At the end of the classes, guys, you will have a confidence in the subject that no matter what the question is, you will be able to answer it. But that confidence as such, guys, you will be able to build that confidence only if you're reading questions on your own, only if you're able to, only if you're trying to solve questions on your own. Whether or not you get the actual answer is a different story. But then, do that. Also, guys, the main reason why I ask students to read questions on their own is that there might be multiple ways of solving a question. If I directly start explaining you the answer, you are obviously forced to think only in one direction. Your brain stops thinking about the alternative ways of solving a question. This is pretty common, guys. This happens with everyone. It happens with me also. So whenever a new question paper comes, obviously I will try to solve the entire paper, because I would want to know how a student will think about the question. What are the different ways in which a student will try to think about the question. Likewise, guys, if I am giving you time, you might have a different approach of solving that question. I'll be more than happy to discuss why that approach is right or why that approach is not correct. For that, remember again, you will have to inculcate the habit of reading the question on your own. Otherwise, it is not going to work. That is the importance of reading the questions on your own. I hope I'm pretty clear about it, guys. Only one important point that I'm trying to tell you here is that utilize this 3 hours effectively. You are waking up so early in the morning, guys, to do these classes. You have articleship. Both of them are equally important. I'm not telling you guys that you'll have to give importance only to your studies or give importance only to your articleship. It is also pretty important that you clear the examination. It is also very important that you have a personal life. It is also important that you learn during your articleship. So all the things are important. Have a proper work-life balance and also ensure that you take out time for your studies. Another important thing beta is that we will be maintaining 2 notebooks. Now, you do not have to worry if you did not purchase 2 notebooks yet. For the first couple of days, we will only be needing 1 notebook. But then yes, we will be maintaining 2 notebooks. In 1 notebook, guys, we will only write concepts and explanations. In the other notebook, there will be problem solving. So whenever we start a new chapter, whenever we're discussing a new concept, we would be writing in notebook number 1. We will call that as a concept book, and problem solving in a separate notebook. There will be approximately 600 plus questions that we're going to solve during the entire course of this 75 days. Yes, but there'll be a lot of questions that we're going to practice. That is why I said, but a subject like SFM will always keep you on your toes. You will have to be very attentive. So this concept book that you're going to maintain itself will become your summary book. It will help you in quickly revising everything one day before the examination as well, or during your preparation leave, during your revisions as well. So and maintain 2 notebooks. The concept book as such beta might just take 150 sides, most likely 100 to 150 sides. As far as your notebooks are concerned for problem solving, we might take 4 or 5 notebooks for problem solving. If you're someone who's maintaining a register, that is a 400 page register, then you might need 1 register and one small notebook for solving questions. I do not believe in directly printing solutions in the material that I'm providing you guys. There's no point. See, ultimately you will find printed solutions in ICI material, you'll find them in RTPs, you'll find them in mock test papers. The important thing, the important reason why we're doing classes is that we are able to solve questions on our own. So for that, let us solve. Why should we just go through printed solutions? There will be additional questions for practice at the end of every chapter. I will be providing you the solutions for those questions only, but not of the main problems that you're supposed to solve during the class. I hope I'm clear about this, guys. Remember, you're supposed to maintain 2 notebooks as and when I'm discussing a concept, irrespective. Ek second, beta. Is there any message here? No. As and when we are discussing a concept as such, beta, even if I do not remind you, ensure that you write it only in the concept book and all the problem solving in a separate book. I will not be telling you regarding the entire syllabus of SFM on the very first day, guys. You will not understand the entire syllabus of SFM now. Is your syllabus of CA Inter relevant? To a certain extent, yes, guys. Your whatever other concepts that you've learned at CA Inter will be relevant. We will be revisiting those concepts as and when required. Or in the first couple of days, I'll be only discussing time value of money. In spite of the fact that you've done time value of money, guys, in CA Foundation, in CA Intermediate, we will still have to do time value of money again, because almost the entire SFM syllabus is based on time value of money only. So if your concepts, if your understanding of time value of money is very good, you can start playing with the subject. So we will be doing time value of money in the first couple of classes. उसके अलावा guys, as I told you, CA Inter का syllabus, as and when required, we will also be doing the concepts of CA Intermediate, and everything will be taught from the basics. It does not matter whether you remember the concepts that you've learned at CA Foundation and CA Intermediate or not. That is one reason why I again start from scratch, even when it comes to time value of money. Now guys, coming to this paper, strategic financial management. Just like your CA intermediate papers, guys, any other paper of CA intermediate, strategic financial management also will have 6 questions of 20 marks each. You will have 6 questions, guys, of 20 marks each. Question number 1 is obviously compulsory, and from the remaining, from question 2 to question 6, beta, you're supposed to answer any 4. But what is the most important part here is that there is no separate theory question. Theory is combined with every question. I'll just show you guys. I might have put a question paper here. This is a question paper, guys, of SFM, the recent question paper. If you see, guys, this first question, which is compulsory, there's an 8 marks practical question. There's an 8 marks practical question again, and we have a 4 marker theory in the very first compulsory question. In the second question, again, we have a theory question for 4 marks. In the third question, we have a theory question for 4 marks. In the fourth question, we have a theory question for 4 marks. So basically, there is theory included in every question. We cannot ignore theory. We cannot ignore theory at all as such, beta, no matter what happens. There are 2 theory chapters from which there will be 2 pure theory chapters, from which you will have at least 3 theory questions coming in the examination. So in every chapter, I will tell you guys as to what is the expected theory questions. Practical topics mein se, you know that there are only a couple of theory questions that are relevant. Only those can come in the examination. From pure theory topics, they're obviously going to ask those theory questions in the exam. There is a weightage that ICI has dedicated to a combination of topics. Usually, they will try to revolve around that weightage only. So you will know as to what is expected from a student also. But again, remember, you will have to attempt theory of at least 20 marks no matter what happens, because there's a 4 marker theory included in every question almost. Sometimes they might not include a 4 marks theory in one question. So bare minimum 16 marks, normally 20 marks theory, guys, you will have to attempt. Questions are divided like 8 marks practical, 8 marks practical, 4 theory, or you can have 12 marks practical, 4 marks practical, 4 theory, or you can have 6 marks practical, 10 marks practical, and 4 marks theory. You will never see a practical question coming for 20 marks. You will never see a practical question coming for 16 marks directly. This is not financial reporting. We are doing strategic financial management. So this is how they normally divide, beta. This is how you will normally see the questions being segregated into. This is a very, very scoring paper, guys. Very scoring paper. You can always aim to score 90 plus in this paper. Scoring 95 plus is also easy. It all depends on the question papers also, guys. You can never compare marks, obviously, of one attempt with the other attempt. Every attempt paper is different. So this is about your question paper pattern, which we would be revisiting again once we do every topic. At the end of every chapter, guys, I will be giving you the weightage of that topic in the previous 6 question papers. So how many marks a particular topic has come for, and what is the weightage that has been assigned to it by ICAI. This will help us in categorizing topics as category A, category B, category C for the purpose of revision one day before the examination. We should know as to how will we be able to finish 100% revision a day before the exam. So for that, see guys, while you are doing your classes, while you are preparing during your examination leave, while you are revising, you will obviously have to plan that one day also as to how are you going to revise the entire subject one day before the examination. So while we do only, guys, we will start categorizing topics. We will start marking questions as to these are the questions that you will be doing before the examination. Okay. And apart from this, guys, what else did I want to tell you regarding the paper here? Nothing. Okay, now coming to the syllabus, guys. In your CA Inter, your financial management paper, guys, in CA Intermediate was basically segregated into 3 major headings. There was financing decisions. I'm talking about CA Inter financial management, guys. Financing. If you have any questions, guys, you can ask now if there are any questions whatsoever. Or No questions. So yes, but we had financing decisions in which we have covered cost of capital, we have covered capital structure theories, we've covered leverages. We had investing decisions. Under investment decisions, guys, we have covered capital budgeting, investment decisions only. We did working capital management. We also did risk analysis in capital budgeting. इसके अलावा बेटा there was dividend decisions, a separate chapter. And then guys, there was ratio analysis. Of course, if you talk about financing decisions, guys, you can also put sources of finance, a theory topic, guys, under financing decisions. So this is how beta your entire syllabus was segregated under CA Intermediate. CA Intermediate, guys, was never about valuation. We never learned the concept of valuing a security, guys, at CA Intermediate level, excepting one or two small cases, guys. But majorly, guys, your valuation was not covered at CA Intermediate level. CA final, the entire syllabus, guys, is majorly about valuation or about risk management. How can you mitigate risk when it comes to financial securities, or how are you supposed to value a financial instrument? How will you value an equity share? How will you value a debenture? How will you value an entire company? How will you value mutual funds? What will happen if you combine multiple securities? Will your risk increase? Will your risk decrease? How can you hedge your foreign currency risk? How can you hedge your interest rate risk? These are all the things that we're going to learn at CA final level. So it is more about the application side of the concepts that we learn at CA Intermediate level. Every question, guys, will have application of time value of money. Every question will have application of time value of money. Without time value of money, strategic financial management does not work. This strategic financial management paper will also become the basis. This paper beta will also become the basis for your two elective papers. You know that your paper 6 is an elective paper, guys. There is risk management, which is in relation to, I would say, guys, that is more on banking side. And then there is financial services and capital markets, guys, more in relation to the markets. So this paper becomes a basis, guys, for your two elective papers. Not necessary that you do one of these two elective papers only. There is you do not have to rush, guys. You do not have to decide about your elective paper now. You can decide about your elective paper in the last 1 year after you do a couple of classes for a couple of subjects. Then you can decide as to what are you more interested in, or what is more beneficial for you from the viewpoint of an examination, and then take a call on it. So but nevertheless, but this becomes the basis for those two papers also. Okay. Now guys, we would be starting off with the basics of valuation. We would be starting off with time value of money. I always have to switch screen beta time and again to just check whether everything is functioning properly or not. Okay. Can anyone tell me, guys, what valuation is all about? Can anyone tell me, guys, as to what valuation is all about? Or on what factors is a value of security based on? On what factors, guys, is the value of security? Guys, if there's anything, you can always also text in the Telegram group. Remember, I keep that open only during an entire class. Google Drive students, nahi beta, tum log to obviously, guys, you will ask me students, you will ask me doubts. You will leave a message to me in the on Telegram. I'll clear it as and when possible. So, guys, yes, beta. Can you guys tell me what are the basics of valuation, or what are the basic factors, guys, on which the value of a security is based on? Naman, you want to answer something? Okay, Naman here says that based on the financials given in the balance sheet, we will value a company. Sarvesh says that it is demand and supply. Ansh says that it is basically what is the worth. Ansh, a very good answer. Naman, a very good answer. Because Ansh, when you say basically what is the worth, my question is, how do you determine that worth? Okay, you cannot tell me. If I ask you, you know, I do not know, guys, how should I put it, but then Ansh, can you please elaborate it? Okay, I will rephrase the question. How do you determine what would be the worth of a security? यार तुम लोग घुमा फिरा के मेरा ही क्वेश्चन सिर्फ सेंटेंस चेंज करके मत बोलो यार. Survey says demand and supply will determine the value of a security. It is very good reason. I will be talking about technicals, I will be talking about fundamentals in some time, but whatever survey says will determine the value of a security in the short run, guys. Undoubtedly, demand and supply factors play a very, very important role. Just guys, now what is happening with Afghanistan is causing the prices of dry fruits to increase in a couple of parts of India, because these were the parts which were importing dry fruits from Afghanistan. Because the supply side has reduced and the demand is still at the same levels, obviously prices started shooting up. The prices started increasing. Naman says that it is based on what the financials, whatever are the financials given in the balance sheet. I would not totally agree with it, Naman. Yes, to a certain extent it is correct. But then remember, Naman, say if I present you the balance sheet of Vodafone Idea, you cannot simply value Vodafone Idea on the basis of the existing financials. Remember, valuation, okay, I will come to that point, but yaad rakhna beta Naman that it is not just about all the financials that appear in your all the things that just appear in your financial statements. There are a lot more factors that you will take into consideration. Ansh says that it depends on the instrument. Can you please elaborate again? Ansh, give me example of one instrument and tell me how will you value that security. Niharika says it is based on risk. Okay, undoubtedly the risk will have an impact on the value of a security. Harshil says current. Yeah. Oh my god, that's a very elaborate definition. Ansh, did you Google it? Correct, beta. Whatever he just said, guys, is the most accurate answer. He says that the value of a security is nothing but the present value of the expected future cash flows, nothing else. The fundamental principle of valuation, guys, works on discounting the future cash flows, discounting what you are expected to receive out of a security on a later date. This is how you determine the value of a security. Someone says nature and liquidity also. The nature of security obviously will determine, guys, as to how are you going to value that security. Someone liquidity, current performances and future estimates, undoubtedly correct. You will have to take your current performance, like how Naman also said that you will look at the existing financials. That will determine your current performance. But what I'm more interested in is the future performance of an organization. The future performance beta will determine just say beta there was one stock, one of you only was talking about it in the recent past. You said the minute the minute that the company announced that it is a sole supplier of certain components to Ola Electric. We all know, guys, that Ola is coming with electric scooters, Ola Electric. So the minute the company announced that this company will be the sole supplier of certain components to Ola Electric, guys, this company's share price increased by 20%. It was around the levels of 800 rupees. It went up to 1000 rupees. Now it is trading at 1080 rupees. So see, guys, it is not that the performance increased already better, but then when this announcement was made as such, guys, everyone was pretty sure that the future performance of this organization is going to be very good. The profitability of the organization on a later date is going to be very good. So this will obviously increase the value of the company. This will have an immediate impact on the value of the company. If you talk about Vodafone Idea, guys, the company might have done pretty well, guys, in the past, but then we know that from the last couple of years, guys, from the last 2-3 years, basically, the company has been reporting heavy amount of losses after Jio has entered into the market, after Jio has destroyed all the other players in the market. So the company has been reporting heavy amount of losses. Now we are not sure, guys, whether Vodafone Idea will survive this or not. That is one reason why the share price is still hovering around 6 rupees, 7 rupees. If the company liquidates, if the company basically defaults on their payments, guys, even the shareholders will not even receive 6-7 rupees, because the money will not be sufficient to pay their debt holders also, forget some return to equity shareholders. So if you are guys, placing your money, or if you are betting on Vodafone Idea, you're taking a huge amount of risk. You do not know, guys, whether you will receive that 6 rupees or not, but in case the company survives, you will obviously make a large chunk of money as well. In case the company survives as such, guys, this difficult phase, you'll obviously be making a huge amount of return. So someone said risk is important. So this is where you're bringing in the concept of risk. Now, Yes Bank, guys, has a lot of exposure to Vodafone Idea. So if Vodafone Idea defaults as such, guys, if Vodafone Idea is not able to make their payments, you know better that it will have an impact on the profitability of Yes Bank also. That is why the share price of Yes Bank has declined in the recent 1 month, guys, from 15 rupees levels to 10 rupees, 11 rupees. There are a lot of factors, guys. Ultimately, when you talk about fundamentals, it is just about the present value of future cash flows, nothing else, guys. Now, a lot of people ask Rakesh Jhunjhunwala. I do not know if you know this guy. Rakesh Jhunjhunwala is considered to be the Warren Buffett of India. So Warren Buffett, Rakesh Jhunjhunwala, guys, says that he will not invest in Zomato because he does not see future cash flows here. He says, show me cash flows, then I will invest in a company. The minute you tell me that this company is going to generate some amount of positive cash flows, this company is not going to burn cash flows, only then I would be investing in a company. So that is his philosophy as such, guys. Every investor has a different mindset. Every investor has a different mindset. If all of them have the same mindset, guys, transactions can never take place in the market. If everyone thinks that this is a perfect price for a security, if everyone thinks that the price of this security is going to increase, everyone will want to buy it. No one will want to sell it. People with opposite expectations only, guys, let the market trade securities. If everyone has the same expectations, you will never see a transaction occurring unless and until someone is in need of money. Otherwise, why will someone want to sell if all of them have the same expectations? If all of them have the expectation that a share price is going to decrease, the company's performance is going to decline, then everyone will want to sell. If all of them have an expectation that the share price is going to increase, everyone will want to buy. So things like this will happen. Only because people with opposite expectations enter the market as such, guys, you will see that transactions occur. So fundamentally, guys, when you talk about the basics of valuation, correct, it is all about the present value. We say better the intrinsic value or the fair value is nothing but the present value of future cash flows. Now, my next question, guys, I hope you've understood this part better, that see, you show me cash flows as such better. You show me that what is the benefit that you're going to derive out of a particular security, out of a particular investment. That will determine the value that you're going to pay for any security. That will determine the value that you're going to pay for any security as such, guys. Say, I personally believe as such, guys, that there are a lot of stocks in the market which do not actually command that value. Matlab, the prices that are trading in the market are overvalued. There are certain stocks which do not deserve that price at all, but then they're still trading at it. But that is another fact. Like how survey says, it is demand and supply. There are a lot of cases that are in the market where only demand and supply will artificially increase or decrease the price. It happens a lot in the markets. This is where retail investors, guys, end up losing. You should understand the difference between demand and supply triggering, influencing the price of a particular share, and fundamentals influencing the price of a share. If it is purely fluctuating on the basis of demand and supply as such, guys, it is a very risky instrument. Okay, guys, coming back to this, we will be talking a lot about markets as well. Every discussion that you're going to, every discussion, guys, of every concept will be practically related. It will be based on what actually happens out there. Let it be any chapter as such, guys, we would be relating it to the practical scenarios for proper understanding. Irrespective of whether you want to make a career in finance or not, guys, this subject is important. This subject is very, very important, guys, irrespective of whether or not you want to make a career in finance. I'm not telling you that you're going to use the entire part of entire SFM in other fields, but then basics of this topic subject are required. And plus, if you do this paper properly, guys, it will help you a lot in case you're writing CFA. It will help you a lot, guys. You can directly go through all your notes of CFA level 1 and clear the examination easily. You will not have to struggle to clear CFA level 1 after doing this. Coming back to this, guys, if intrinsic value or fair value is simply the present value of future cash flows, why is it so difficult to value a security? If it is as simple as this, guys, if it is just the present value of future cash flows, why do you think, guys, that it is difficult to value a security? What makes valuation such a difficult process? Why do we say that valuation at the end of the day is an art but not a science? Had it been a science as such, guys, everyone would have known, boss, this is the value of the security. There is nothing else that this security can command. But we say valuation is an art. It is not a science. What makes valuation a difficult process? This is the time where you're supposed to answer. An amazing answer there, uncertainty. बोलना बहुत easy है बेटा that this is future cash flows. The future is uncertain. Especially when it comes to the return that the equity shareholders are going to generate, guys. The future is totally uncertain. Let us not forget that equity shareholders, guys, get whatever is left after payment. So what is the amount that these equity shareholders are going to get, guys, is all uncertain. What is the amount that I am going to make on a later date is all uncertain. There is no guarantee. There is no surety. If you compare a salaried person with a person who's into business, undoubtedly, guys, the businessman's future is a lot more uncertain. It is a lot more uncertain. You cannot estimate, you cannot predict the future accurately as such, guys. Valuation is about these uncertain cash flows. See, you might argue, sir, when it comes to a debenture, when it comes to a bond, we at least know that these are the amount of cash flows that we are going to generate. No doubt about it, guys. Debentures or bonds or preference shares, you at least know that this is the amount of cash flow that you're going to generate. But isn't there credit risk involved even in debentures or bonds? When I say credit risk, guys, what if the other company defaults? There have been so many cases of guys, defaults in the recent past. So many companies have defaulted on their debt payments. Are you telling me that a debt security holder, guys, will not is undertaking zero risk? ऐसा कुछ नहीं है बेटा. Even the holders of debentures as such, guys, take some amount of risk, and that comes in the form of credit risk. There are other forms of risk also, guys, called as price risk and reinvestment risk, which I would be covering in the very first topic called as bond valuation after a couple of days. But as of now, there is some amount of risk involved even in bonds or debentures. This uncertainty, beta, is what makes valuation a very difficult process. If you ask me to value, say, a company like DMart, I would say first thing that I would write is assumptions. I am assuming that DMart will continue to open stores at this rate. I am assuming the same store growth, SSG, very, very important in retail companies. I will be talking about terms like this, but abhi ke liye samjho, when I talk about DMart, when I talk about Domino's, what companies, what shareholders better track is not just you opening new stores, because at some point of time, guys, you might have to stop opening new stores. You might be more interested in knowing what is the same store growth also. Matlab, the same store, beta, how much are their revenues increasing by? DMart might say, beta, that the same store growth is say 15%, 20%. So I will be taking assumptions regarding the number of stores that they're going to open. I will be taking assumptions regarding what is the same store growth. I would be taking assumptions regarding whether they will, majority of their new premises will still be owned, or are they going to take it on a very long lease periods. So how will that impact their profitability? I would be taking assumptions regarding the interest rates prevailing in the market, which will again have an impact on, the cost of capitals. So there are again, I will have to take an assumption regarding the margins that these companies are going to make. I will have to take an assumption, guys, regarding the competition that might prevail in the market. What if there's an intense competitor as such that enters the market? That will obviously have an impact on the margins of all the players. That is what happened in the telecom industry as well. So these valuations, guys, are based on a lot of assumptions. What if some of these assumptions go wrong? This is why you have learned about sensitivity analysis under risk analysis, guys, in CA intermediate. There are a lot of assumptions here. A lot of factors can change. This makes valuation an art. When you have to value any company as such, guys, when you talk about valuation process, people assign different probabilities. They say worst case scenario, this can be the share price. Best case scenario, this can be the share price of a company. On an average, on a most likely scenario is this. So they assign different. So matlab, no one knows, guys, as to what is the perfect price. No one knows what is the perfect value, because you're still dealing with uncertain cash flows here. That is why valuation is a difficult process. Valuation is not merely just applying. You do not know beta with certainty that this is the amount of cash flows that they're going to generate. But do not worry, guys, as far as our questions in the examination are concerned, they will tell us, no, what is the assumption. They will tell us, assume that the dividends are expected to grow at a rate of 8%. Assume that the cash flows are going to increase at a rate of 6%. So subject to those assumptions, we will be able to arrive at the value of a security. Subject to those assumptions, guys, we will be able to arrive at the value of a security. And our concentration in CA final, guys, is only on, majorly, guys, only on the present value of future cash flows, because fundamentally this is how you value a security. Practical world mein beta, there are other valuation methods also. Startups mein beta, they might value on the basis of GMV, gross merchandise value, beta e-commerce businesses reh sakte. There are few businesses that are valued on the basis of number of users, number of customers. So with a hope better that these entities will make profits on a later date. All of this is just based on a hope that they will make profits on a later date. So yes बेटा, this future is uncertain. ये जो अपन future की बात कर रहे हैं बेटा, all of this is uncertain. Okay. Anything else, guys? You said present value of future cash flows, guys. So there is cash flows, which is a very important factor here to, in order to arrive at the value of any security. And these cash flows can be uncertain. Even if they are certain as such, better, they can be risk involved. So what, to compute present value of future cash flows, you need cash flows. Any other factor that you need? Now this is a question where you answer, guys. Any other factor, guys, that you might need to arrive at the present value of cash flows? Discounting factor, discounting factor, discounting factor. Of course, guys, you need discounting factor. And how is this discounting rate or discounting factor computed? How is this discounting factor or discounting rate computed, guys? Now that's another question, guys, that I'm asking you. How is this discounting factor or discounting rate computed? इसके पहले आंसर कर रहे थे बेटा सब लोग? You've answered this earlier. One second. You have shifted. Opportunity cost. Taken generally as cost of capital or cost of the instrument. Cost of capital. So major. Okay. Majority of you say it is the cost of capital. Mishika says it is opportunity cost. Now, Karthik, can you tell me as to what exactly is, how do you compute cost of capital? I'll also wait, guys. Can someone tell me, guys, as to how do we compute cost of capital? You can talk. There's a lot to type if you are planning to type. बच्चों, सो गए क्या? You're telling me that the overall cost of capital is based on cost of debt, cost of equity, and cost of preference share capital. How do we compute cost of debt? And how you're telling me that the cost of debt is computed on the basis of the rate at which the debentures are trading in the market. And how do I compute that rate? Sir, don't keep asking questions पे questions, sir. जितना बोले उतना सुनो ना आप. Okay. Now, Janvi, you're talking about actual return that you're supposed to generate from the security. You're telling me that you will not be willing to take up an investment. You will not be willing to invest in a security if the actual return that you are generate does not exceed the cost of capital. But then my question was, how are we determining what is the cost that you have incurred, or what is your cost of capital? What is your opportunity cost? Yes. Correct, Mohit. So you are telling me that cost of debt is interest rate into 1 minus tax rate. इसको हम लोग बोलते हैं postmortem report बेटा. So imagine guys that I am the head of say for example Tata Motors. Now Tata Motors is doing good, and I'm supposed to raise more capital for the purpose of expansion. I decide that I will issue debentures, I will issue bonds. I'm issuing debentures say beta with 10 years maturity. And the CEO of the organization calls me, guys, say I'm the CFO, and he's calling me and is telling me what is the cost of debt, and I'm telling you it is interest rate into 1 minus tax rate. The CEO says excellent, but how are you deciding what is the interest rate? I'm telling him, no, not relevant, because the formula that they taught us was interest rate into 1 minus tax rate. You cannot ask me what is interest rate here. Correct. See guys, whatever we have learned at CA intermediate level, no, as far as cost of capital was concerned, that was like post-mortem report. Matlab, you have already issued debentures at this interest rate, at this, you've collected so much of net proceeds. This is the amount of your redeemable value, and this is how you compute your. So based on these factors, this is the effective cost that you are incurring. My question is, when I'm issuing debentures, how do I determine as to what is the price at which I'm supposed to issue debentures? What is the coupon rate that I'm supposed to offer to the investors? Anyone? Manisha Sirvi says it is P. Now I will, guys, we are not playing a game here. You cannot just give me hints like that. P up to decide कर P का मतलब क्या है बोल के. Sarvesh, you want to answer something? आगे नहीं बोलना था बेटा. You should have just stopped at how depending on risk. आगे बोल के आंसर खराब कर दिया तो. Yes guys, the perfect answer beta is that it depends on the amount of risk. This document guys, if you can see clearly, this talks about the 1-year government security rate in India and a 10-year government security rate in India. The 1-year government security rate in India as on 31st August is 3.86%. 10-year rate is 6.23%. In the previous month, it was 4.02% and 6.37%. Or if you wish, this is 1-year government security rate, 2-year government security rate, 3-year, 4-year, 5-year, 7-year, 8-year, 9-year, 10-year. Yeah, every month the rates keep changing, so that is why beta there's a list of long list here, guys. August 2021, July 2021, mein how much were the interest rates? June 2021, how much were the interest rates? In any economy, guys, there is something called as your risk-free rate. And risk-free rate, guys, is nothing but the return that you are generating on government securities. Whatever is the return that you generate on government securities, guys, becomes your risk-free rate. Why do we term this as risk-free rate? Because we expect that the government will not default. The government cannot default. So there is no, matlab, see guys, we know that there are debentures and bonds in which cash flows are certain. Matlab, you know that this is the amount of cash flow that you're going to generate in on a debenture or a bond. There is no uncertainty as far as cash flows are concerned. Cash flows are certain. We know that this is the amount of cash flow that you will generate from a debt security. However, I told you that there can be something called as credit risk. What if the other party defaults? I give my money to a friend. I give my money, say guys, to a family friend, and then that person defaults. A majority of Indians, guys, end up losing money when they give it to a friend or when they give it to a family friend or a family relative. I'm not discouraging you people, guys, from not helping your friends and starting their businesses, but then do understand, guys, that a majority of defaults occur here. इसको हम लोग क्या बोलते हैं? This is called as credit risk. What if the other person defaults? What if the other person does not repay? You wanted to generate a return which is more than the bank deposit rate, which is more than the interest rate on debenture, and hence you gave away your money to a friend at a higher interest rate. You wanted to make an interest of 12%, 15%, and that person ran away with your money. You are not generating any return at all. Possible? Possible. So based on that default factor, guys, we say that the government cannot default, because the government cannot default as such, but whatever is a return that we are generating on a government security is termed as risk-free rate. But not every investment of ours goes into government securities. How these government security rates change, we will talk about that in the very first chapter, bond valuation. Right now, guys, my objective is to tell you as to what is this required rate of return, how is this calculated. So guys, risk-free rate is government security. A lot of we consider the 10-year government security rate as a benchmark usually for all the long-term investments. When you invest in an equity share, when you're investing in a long-term debenture, guys, the 10-year government security rate can become your benchmark rate, which as of now, beta, is 6.23%. If you invest in a government security which matures after 10 years, beta, you are going to effectively generate 6.23%. In a shorter period as such, guys, you're going to generate only 3.86%. If you invest in a 1-year government security today, you will generate only 3.86%. So this is your risk-free rate, okay? But when you invest in the debenture of a company, when you invest in equity share, there is some amount of risk that you're taking. It is not that you take zero risk. So this is where, guys, you will have to also incorporate the risk factor. You cannot merely take a decision on the basis of this risk-free return. This is where, guys, there's something called as the credit rating of a company that comes into picture. In India, guys, we usually, credit rating ka matlab kya hota hai beta? Credit rating is determining the credit worthiness of a company. I'm talking about debt securities, guys, as of now. I will come to equity securities also, guys. Please understand first. My objective here is to first give you an idea as to how these companies determine their coupon rate, how these companies determine their interest rates. There's Edelweiss Financial Services. They've come out with a debentures issue last week only. They're offering 9.5% return plus 0.2% additional return if you are an Edelweiss customer or something. So that is 9.7%. So how do these companies determine? How does Edelweiss determine that it is 9.5%? How are they computing this? It depends on the credit rating of that company. Credit rating, guys, is determining the credit worthiness of a company. Whether that company will be in a position to honor their payments on a timely basis or not. What is the probability that they can default? तो ये credit rating करवाते हैं, guys. Companies get credit rating done for short-term securities, for long-term securities also. Companies get credit rating done, guys, for short-term securities as well as long-term securities. This credit rating, guys, will determine what is the risk involved in a security. Now I am showing you a screen beta where there are AAA rated bonds. AAA rated bonds matlab highest credit rating. They are considered to be the highest. Matlab they are very less riskier, guys, in compared to other securities. And a AAA rated bond, guys, मेरे को पूरा नहीं चाहिए बेटा, मेरे को सिर्फ long duration चाहिए. Can you see this AAA long duration bond index 7.01 दिख रहा है ना बच्चों? So a government security in India, guys, a 10-year government security is fetching you 6.23%, but a AAA rated long duration bond beta is fetching you around कितना है 7.01%. 7.01%, guys. This is the return that a AAA rated bond is generating. Matlab it is a little more riskier. This is still a corporate beta, so this is little more riskier than a government security. That is why the return involved here, guys, is a little higher than a risk-free security. This is a AAA rated bond. This is a AA plus. AA plus matlab kya, guys? Positive. Whenever they get credit rating done, they have this positive outlook, they have stable outlook, and they have negative outlook. If they say AA plus, it means, guys, they have a positive outlook. The credit rating can increase in the near future. If they say AA stable, they're expecting the credit rating to be in that AA range only. If they say AA negative as such, guys, they're expecting that the rating might decline towards a lower side as such, beta. So ऐसे credit rating है beta. So here if you see, guys, AA rated bond, long duration bonds beta 7.9%. Long duration bonds is 7.9% for a AA rated bond. This is A rated bond, guys, corporate, A corporate bond. Here if you see guys, for long term it is 10.11%. What I'm telling you beta is lower the credit rating, higher the risk involved in that security, higher the risk involved in a security, higher is the return that you will expect from a security beta. So when any company as such guys, when any company beta is determining as to what is the coupon rate that they're supposed to offer, it will all depend guys on the credit rating of that company. Next time when you see some advertisement beta which says that if you deposit in this particular cooperative bank, you will get a fixed deposit rate of 8%, 9%. If you deposit in this particular debenture, you will get 11%, 12%. Do not blindly compare that 11% with the FD rate that you're getting from HDFC Bank or Axis Bank. Let us first not forget the fact that the risk involved in these two securities can be totally different. HDFC Bank can offer a pretty low fixed deposit rate, can offer a pretty low savings interest rate than IDFC First. IDFC First might be offering you 6%, 7% interest rates. That is because they went through a bad phase. The credit rating as such, but is not that great. That is the reason why they're offering a higher rate of interest. So this credit rating will determine the risk involved in a debt security. Lower the credit rating, higher the risk involved in that security. Higher the risk involved in the security, higher would be the expected return. Tell me guys, if you are putting your money, if you are betting your money as such guys on a cricket match, if you bet on a cricket match, do you really expect an annualized return of 6% per annum? Will you be expecting an annualized return of 6% guys when you're placing bets on a cricket match or when you're playing cards as such guys? You are not expecting a return of 6% boss. You're not expecting a return of 10%. You know guys that it is either plus 100% or minus 100%. That too guys, the time period involved is very short. Okay? The risk involved there guys is so high that you might end up losing the entire principal. That is why guys, you are also expecting a huge return in case you win guys. ये required return है. You are expecting that beta that in case you win, you are taking a very high amount of risk. That is why you would want to be remunerated with a very high return. You would want to be remunerated beta with a very high return. That is why as such beta, the risk involved in a security will determine. Say when you're investing in a startup guys, do you really think you will expect the same return? Nahin na. If you're investing in a startup guys, you're taking a huge amount of risk. You do not know whether this business will succeed or not on a later date. You do not know beta as to what is the amount of return that you're going to generate from this on a later date. So there again, because the risk involved is high, you would be expecting a higher return. Now you'll be like, sir, why should I invest then in all of these securities? There is always greed for generating a higher return guys. I'm not telling you that for sure you will end up losing the entire money. There is a chance that you might lose the money. There is a risk involved. And that is why you expect a higher return. So prima facie guys, when someone tells you how do they determine required rate of return, boss, it depends on risk-free rate. Plus there is a premium for the risk that you are undertaking. The required rate of return from any security is the risk-free rate. Risk-free rate beta will become the government security rate. The government security rate as such guys, that would be your risk-free rate. Risk premium as such beta would be nothing but would depend upon the risk involved in the security. Again here also beta, the nature of security will determine. If you are putting your money in a debt security, if you put your money in an equity security, where are you taking a higher amount of risk? Are you taking a higher risk when you put your money in a debt security, or are you taking higher risk when you put your money guys in an equity share? Can you tell me, answer this guys? Do you take more risk when you invest your money in an equity share, or do you take more risk when you invest your money in a debt security? There's a higher risk in equity share, sir. This is the very first thing that you have explained us. Correct. Equity share. Yes. The risk that you take as an investor is higher beta when it comes to take the example of Vodafone Idea. Say you purchase shares of Vodafone Idea today at 6 rupees or 7 rupees, and tomorrow the company liquidates. Do you think they will call you first? They'll be like, अरे मोहित भाई चलो घर पे आओ, पहले तुम्हारे पैसे देते हैं, बाद में we'll talk about all the other debt holders? No, right? They will obviously want to clear. They will obviously, there's a order of repayment as such. Beta, the debt holders are entitled to get their money first. Usme bhi beta, you have those preferential creditors, overriding preferential creditors. You have secured creditors, and then you have unsecured creditors. After that, your preference shareholders. And if something is left after that, also beta, equity shares will be like, ठीक है sir, please हमारे को भी थोड़ा बहुत दे दो. Equity shareholders take a higher. Their return is not fixed. what they are entitled to is the leftover return. In case of liquidation also, what they are entitled to is the leftover assets that are leftover assets, whatever is left after paying all the external liability holders, all the preference shareholders. So the risk that is taken by an equity shareholder is undoubtedly very high. That is why, guys, when you invest in an equity share, you're obviously expecting a higher return. Why do people invest in equity markets? Why do people invest in mutual funds then? At this age, guys, most of you, when you've just started your articleship, I'm pretty sure that you must have opened your mutual fund accounts. If you did not do it yet, I will ensure that you start investing in mutual funds. Matlab, obviously I cannot force you, but then I will guide you after a couple of days. But then why do people still invest in mutual funds? Beta, why do people still invest in equity shares? The return that you're expecting is high, and you also know that the actual return that you will generate over a longer period beta will be high. So if you invest in a mutual fund today, guys, you might easily generate a return of 12% per annum, compounded annual return of 12% per annum. While you invest in a debt security, depending on whether it is AAA rated bond, AA rated bond, or A rated bond, you might, guys, generate 7%, 7.5%, 8, 9% return, not more than that return. Correct? So you still invest in equity. It is not that beta you will want to park your entire money only in one risky security. Diversification of risk is another topic that we do under portfolio. Matlab, see guys, through with the help of SFM, obviously you will understand a lot about your personal financial investments also. Not just about how the corporate world, corporate finance works, but also about your personal finance investments. But then yes, we do still invest in equity shares, we do still invest in mutual funds, because we would want to generate a higher return on our investments. We are willing to take a certain amount of risk at this age. When you are 70 years old, when you are 65 years old, you might not want to take risk of investing your money in equity shares. Wahan pe beta you will want to avoid taking risk. So at that point of time, beta, people are happy by investing their money in debentures, by investing their money in fixed deposits or government securities. They'll be like, "Theek hai bhaiya, we are generating 5-6%. We are more than happy about it. Lalach mat do. Do not give us this greed of generating more money. We will not buy all of that." So guys, nature of security is important. Risk premium hai beta, risk involved in the security. Risk involved that depends on the credit worthiness as such, but it can depend on the nature of security also. Anything else, guys? Risk premium में risk involved है, that is dependent on the credit worthiness. Nature of security, मतलब if you compare preference share, equity share and debentures, you obviously take lesser risk in debentures. Within debentures also, guys, you will take lesser risk when you are buying a short-term duration bond, and you take a higher risk when you buy a long-term duration bond. तो ये जो government security rate है बेटा, risk-free rate है, that also depends on time period. That also depends on time period. मतलब क्या guys? This I told you बेटा, 1 year government bond rate was around 3.86%. Whereas a 10-year government bond rate beta was around 6.23%. The possibility of fundamentals changing, guys, drastically over a shorter period are obviously less. The possibility of fundamentals changing heavily, guys, over a longer period is quite high. Once great company as such, guys, can default over a very long period. ऐसा नहीं है कि guys, just because you are a very big company now you'll always remain a very big company. There's still a possibility, guys, that over a longer period a lot of factors can change. Now how Ola Electric, guys, has challenged, matlab is becoming a very big threat, guys, to almost all the two-wheeler automakers. Almost all the two-wheeler manufacturers, guys, are facing the threat from Ola, guys. What if this Ola Electric beta actually becomes a very good, actually brings out a very good product as such, beta, then the sales of all the other companies will take a very bad hit. And Ola Electric has already announced that they will get into four-wheeler electric segment also from the year 2023. There are these ministers also announcing that the electric vehicle startups are posing a threat to the traditional automakers. The traditional automakers obviously have to revamp themselves, otherwise they will face a threat. So yeah, once a very big organization can also, guys, the fundamentals of such companies can also change over a longer period. So जो अपना risk free rate है बेटा, that depends on time period. Any other factor बेटा that your risk free rate depends on? Someone answered it some time back. Manisha, I believe, has answered it. Any other factor, guys, that the risk-free rate depends on? Will I be giving a break? No, guys. Yes. I'm not sure. It depends better. Usually if you have, see, if I give a break, that the total class duration will be 3 hours 10 minutes. If I do not give a break, the total class duration will be 3 hours. So wherever required as such, better, we will be taking a break. Today being the very first day, I might not actually take the entire 3 hours as such, guys. I might leave you a little early only, but still, jab bhi required hai, we will take a break. So government stability will determine the risk-free rate. So if you compare returns of different securities, different government securities, the government security rates will be different. Correct, Niharika? If you cannot compare the risk-free rate of India with the risk-free rate of some other country, just say guys, India has a good amount of foreign exchange reserves, $600 billion plus foreign exchange reserves. So though the credit rating of the company is BBB minus in the international market, guys, but still, we have been borrowing extensively, guys, so that borrowing has also caused our risk-free rate. I will talk about something called as open market, guys. There's a lot to learn in finance, you learn, you have learned about a majority of things in economics also, guys. If you remember your monetary policy, how RBI intervenes, guys, to control the interest rates prevailing in an economy. जैसे right now, guys, एक particular bond का 52% of the outstanding bond government का 10-year government security 52% almost is still held by RBI. Not held by other investors, it is held by RBI only. RBI has been purchasing it left, right, center from the open market to keep the prices under control. They want the prices, they do not want the interest rates to decline as such, better. They do not want the interest rates to increase way too much. But RBI is not openly accepting it that they're doing it, but RBI does not want the 10-year government security rates to increase beyond beta say 6.3 6.4%. They're trying to control it. Matlab for months together they were able to control it in the range of 5.9 to 6.1%. Abhi recently it has increased to 6.23 6.3%, but RBI intervenes. So there is government security. Someone says there is inflation. Yes, beta, inflation is a very important factor that determines your risk-free rate. What India follows, there are certain macroeconomic factors, guys, that every economy follows, that every economy is concerned about. So in India, guys, we follow inflation targeting. So we do not have a fixed target for inflation as such, guys. We have a long-term inflation target of 4% plus or minus 2%. We are comfortable as far as long as the inflation beta is ranging between 2% to 6%. That is the target that we have set, guys. Every 5 years we keep changing the targets. So 2 to 6% is our inflation target. Right now, guys, if you compare the inflation rate, a month back it was around 6.5% also, guys, but then it has now come down below 6%. Inflation rate changes the quantity of goods that you can buy, guys. Say if in the year 1980, guys, you were able to buy a basket full of commodities with a given amount of money. So this was in the year 1980. In the year 2000 as such, beta, you might not be able to buy the same quantity of goods. The quantity of goods that you're buying, beta, say is reducing by half. And say in the year 2021 as such, guys, it is only so much. The quantity of goods that you buy with the given amount of money, guys, reduces. The quantity of goods that you buy with the given amount of money, beta, reduces due to inflation. So if you are parking your money somewhere as such, guys, say if you just put your money, guys, in your house, if you just put your money in your house, what will happen? Nothing, sir. Say I put 100 rupees in my house, guys. After 10 years, I take out that 100 rupees and I go out to buy goods. Don't you think, guys, the quantity of goods that I will be buying with that given amount of money has reduced drastically? Yes. So this interest that you generate, beta, should become a compensation for a decrease in the purchasing power of money also. We have discussed this, beta, at CA Foundation. We have discussed this at CA Intermediate level also. But the interest that you generate, guys, should become a compensation for the inflation, for the decrease in the purchasing power of money. So logically, guys, if you say, most of us are now generating negative return. Most of us are now generating negative return, guys, on our bank deposits. Because the inflation is around 5.5%, 6%, but the bank interest rate that you might generate, guys, on a shorter period is only 4%, 4.5%. So though your the decrease in purchasing power of money beta is by a higher percentage, and the return that you are generating beta is not compensating for it. Is not compensating for it, guys. Higher the inflation rate, higher should be the risk-free rate. Lesser the inflation rate, lesser should be the risk-free rate. There are many developed economies as such, guys, where the inflation rate is in where the inflation rate ranges from 0 to 1%. That is why beta their interest rates also would be very very less. Japan has an interest rate of 0.15%. 10-year rate is 0.15% only, 0.15%. So that is negligible, guys, because their inflation rate is also quite less. Now you might wonder as to why our government is not increasing rates. If the government increases, if RBI increases interest rates better, it will obviously have an impact on spending. See, when the interest rates are low, people tend to spend more, companies tend to invest more. When the interest rates are less, companies tend to invest more, consumers tend to spend more. This revives the economic activity. The GDP of a country starts increasing. We all know that the businesses have been impacted very badly due to COVID. What is the priority of RBI here, beta, is to bring back the economy on track. That is why there is so much liquidity in the market. That is why they're not concerned about lower interest. They're not concerned about a higher inflation. They say, guys, what is more important is, guys, are you able to hear to me properly? हाँ बेटा. Okay. So what is the priority of the government right now beta is to bring back the economy on track. That is why they have reduced the interest rates. They have reduced the interest rates. RBI सिर्फ एक ही चीज dictate करता है बेटा. If you know, there's something called as repo rate, reverse repo rate, marginal standing facility, which also becomes your bank rate. Repo rate is a rate beta at which banks can borrow from RBI. This has been fixed at 4%. Repo rate is a rate at which banks can borrow from, in case banks need money as such, guys, they can borrow, guys, for a period ranging from 1 to 14 days. Long term repos bhi aa gaye beta. Reverse repo, guys, is a rate at which banks can deposit their money, guys, with the RBI. Reverse repo is the rate at which banks can deposit money with RBI. So RBI can only control these rates, guys. But because of these rates, indirectly RBI influences other interest rates. Indirectly, beta, RBI is influencing. Imagine, guys, that if banks can deposit their surplus money with RBI at 3.35%, and then RBI is issuing securities on behalf of government. Government securities issue कर रहा है. So obviously, guys, the interest rates that will be offered on government securities will be closer to this 3.35%. Now you see, beta, it is 3.86%. It is 3.86%. These policy rates, beta, will indirectly influence the interest rates that are prevailing in an economy. The objective of RBI, beta, is to also decrease the long-term interest rates. I hope it is clear, guys. So anyways, the risk-free return, guys, will depend upon the inflation prevailing in an economy. Different economies will have different inflation rates, so their risk-free rates will be different. Risk-free rate, beta, again, in turn, we say it should be a compensation for both inflation and the additional return that you are generating, guys. The additional return that you generate, beta, over and above inflation factor is actually the real return that you generate. Is actually the real return that you are generating from a security, from the government security. Real return. See, guys, right now if I tell you that our risk-free rate is only 4% for a shorter period, inflation rate, beta, is 6%, your real return is negative, beta. Your real return is negative. You are losing out in real terms. You are losing out, beta, in real terms. You are not generating anything. ठीक है? So this is what I wanted to tell you, beta, that the intrinsic value, the fair value, the fundamental value of a security is nothing but the present value of future cash flows. In spite of such a simple statement, guys, it is not that simple in the real life. Because when we say cash flows, guys, the cash flows are uncertain. It depends on a lot of contingencies. There are a lot of ifs and buts that comes into picture here. Also guys, to compute present value, we need a return. There is a required rate of return that we want to generate guys, and that required rate of return guys will depend on the risk-free returns that prevail in an economy and the risk premium that you are supposed to generate for the risk that you are undertaking. The risk that you are undertaking. Are we clear about this? Any doubts guys so far? You can ask now. Any doubts guys that you guys have? Any doubts guys? No doubts? See beta, if I know that I can borrow money at the rate of 6.7%, 6.8% and buy a house using that, uh, investors would tend to borrow money and buy houses because the interest rates are less. They know that their interest outflow will be less. Ultimately, it is only the majority portion of their outflow will be principal portion. Again, if I tell you, say I can borrow at say 3% to buy an iPhone, I might not mind buying better at 3% and buy iPhone. जैसे guys US में Apple gives away their products better at effectively zero rate. मतलब you just swipe your Apple card better and you pay the amount in 10 installments or 12 installments at zero interest. So if that happens as such guys, people will be like, ठीक है, even if you do not have the entire money now, effectively you are anyways paying zero interest, so you can very well buy a Apple iPhone or you can buy a MacBook, whatever product, by swiping your card and then pay the money on a later date. So you tend to influence people to spend more by telling them that anyways your borrowing cost is very less. Companies might want to invest more guys because they know that their effective borrowing cost has reduced, so their outflows will be less, so they will not mind taking risk by borrowing money and investing more. That is one factor. Though beta, it did not happen much in the last 1 year because there is still a lot of uncertainty. It is not just investment. Companies would also want to expect a revival in consumer spending. अभी जो Q1 GDP के figures आए बेटा last on the previous day, the private spending guys has taken a hit. And ultimately guys, I am not sure how much you are aware of it, but then private consumer expenditure better makes almost 50% of your overall GDP, 50 to 60%. So if you want your economy to grow, we would expect a revival in consumer expenditure. So these are all interlinked activities guys. If a company is investing more, a company is manufacturing more, then the incomes of individuals will increase. If the incomes of individuals increase, they will spend more guys and they will buy more of commodities. This is how an economy works. So all of these things are interrelated. Yes guys, any other doubts? Any other doubts guys? No other doubts? Bhavesh, are you still sleeping? सो रहे हैं हम. अच्छा, he's typing. Yes guys, I hope we're all clear about this. Let us write these basics in the books better. All of you guys, write the heading as basics of valuation. Guys, all of these concepts are going to help us in every topic. We are just trying to get an idea about valuation process. It is going to help you a lot better on a later date. लिखो बेटा अभी के लिए basics of valuation. You can also text in the group there. वहाँ पे कोई भी नहीं कर रहा है ना. Basics of valuation guys. Write down the intrinsic value, the fair value, the intrinsic value or the fair value, the intrinsic value or the fair value, intrinsic value or the fair value is the present value of all future cash flows. Is the present value of all future cash flows. Is the present value of all future cash flows. So the fundamental value of a security, the fundamental value of a security, the fundamental value of a security, fundamental value of a security, fundamental value of a security is based on two important factors, is based on two important factors, based on two important factors: future cash flows and future cash flows and future cash flows and required rate of return, required rate of return, and the required rate of return. Next point, the future cash flows. Next point, guys, the future cash flows, the future cash flows are not always certain, are not always certain. The future cash flows are not always certain, are not always certain. Equity shareholders, equity shareholders, equity shareholders, equity shareholders are entitled to profits, are entitled to profits, are entitled to profits left after, are entitled to profits left after payment to all other providers of capital. Equity shareholders are entitled to profits left after payment to all other providers of capital. Left after payment to all other providers of capital. All other providers of capital. Even in case of a debt security, 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 though the cash flows are certain, though the cash flows are certain, there is still credit risk involved. There is still credit risk involved. There is still credit risk involved, which is a probability that a company can default. Which is the probability that a company can default. Which is the probability that a company can default. Probability that a company can default. Computation of future uncertain cash flows. Computation of future uncertain cash flows. Computation of future uncertain cash flows. Future uncertain cash flows are based on a lot of assumptions. Computation of future uncertain cash flows are based on a lot of assumptions. If I'm going too fast or too slow in dictating, guys, you can tell me. Hmm. So computation of future uncertain cash flows are based on a lot of assumptions. Based on a lot of assumptions. Based on a lot of assumptions. Next. ये लिखो बेटा. Required rate of return. Two components. There is the risk-free return and the risk premium. Risk-free return and the risk premium. Risk-free return beta is the return generated from government securities. Return generated from government securities. The risk-free rate in turn, the risk-free rate depends on the risk-free rate depends on the risk involved in a security. Sorry, I'm so sorry, beta. The risk-free rate depends on the inflation prevailing in an economy. Interest works as a compensation for interest works as a compensation for a decline in the purchasing power of money, a decline in the purchasing power of money due to inflation. Interest works as a compensation for decline in the purchasing power of money due to inflation. Higher the inflation, higher will be the interest rates. Higher will be the interest rates. Higher the inflation, higher will be the interest rates. The government security rates also depend on maturity. Government security rates also depend on maturity. Longer maturity will yield higher interest rates. Will yield higher interest rates. Longer maturity beta will yield higher interest rates. India में guys, you can write this 3.86% and 6.23%. 1 year government bond rate beta is 3.86%. A 10-year government bond rate is 6.23%. 6.23%. ये भी लिखना फिर. Japan has near zero interest rates. Japan has near zero interest rates. Japan has near zero interest rates. Are we clear about all of this? So this is your risk-free return, guys. Next bit, write down the risk premium. The risk premium expected from a security The risk premium expected from a security will depend on the risk involved. Will depend on the risk involved. Will depend on the risk involved. The credit worthiness. The credit worthiness of a company. The credit worthiness of a company is determined by a credit rating agency. Is determined by a credit rating agency. AAA rating, AA rating, A rating and so on. इसके बारे में बेटा we will discuss, but this is all for your understanding. Credit ratings, AAA, AA, A, so on. .11%, 7. One second, guys. अब ये लिखो बेटा, इन इंडिया a AAA rated long duration bond, as of now beta, as in when we're taking this class now, it is 7.01%. A AA rated long duration bond is 8.45%. It is 8.45%. A rated long duration bond average is 10.11%, or say approximately 10%. Approximately 10%. These are the yields beta that you're supposed to generate depending on the risk that is involved in the security. I hope you're all getting this point beta properly. So the credit worthiness of a company is determined by a credit rating agency, guys, and based on that we've written their returns. Next, guys, again, in comparison to a debt security, in comparison to a debt security, in comparison to a debt security, equity shares involve a higher risk. Involve a higher risk. In comparison to a debt security, equity shares beta involve a higher risk. So the risk premium, for an equity share, the risk premium for an equity share would be higher than the risk premium, guys, for an equity share would be higher than the risk premium would be higher than the risk premium of a debt security. Of a debt security would be higher than the risk premium of a debt security. Guys, are you aware of a fact that the credit rating of any company in the international market, I repeat, the credit rating of a company, guys, in the international market cannot be more than the credit rating of that country's government sovereign bond, even if that company has a lower risk of default. So it happened better. Once there was a very big article on this. Reliance Industries' cost of debt in the international market did not decrease because of the credit rating of India. Reliance Industry cannot enjoy a better credit rating, guys, than the Indian sovereign bond in the international markets. So it is that is why, but in the international markets, the return that Reliance Industries security was generating was more or less the same return that India's government security was generating. ऐसे भी होता है बेटा. See guys, when I say triple A rated long duration bond is fetching 7.01%, let us not forget beta that this is an average return. This is an average return, guys. This is based on 14 companies in 14 companies, 14 most liquid companies of AAA rated beta. These are all nifty indices, guys. I'm picking it up from NSE website only. They compute it on the basis of 14 most liquid debt securities. So there are other companies beta which are not as liquid as these 14 companies, so they might fetch a higher return than 7.01% also. So guys, so far, do you guys have any doubts? So far beta, do you guys have any doubts? Any doubts, guys? Yes. So, why a 10-year government bond rate is higher than 6 months rate? So, as far as the Indians are concerned, we assume that the government cannot default. But then, when it comes to the credit rating of India in the international markets, India's rating in the international market is not AAA beta; it is triple B minus. So, as per the international markets, there is still because India's borrowing cost is so high, because India's interest portion as a portion of total expenditure. I do not know, guys, if you guys have a habit of analyzing GDP, but then if time permits, kabhi to bhi I will analyze GDP also, the different components of the expenditure side also, कि कैसे इंडिया का expenditure burden, interest burden बढ़ते जा रहा है. So all of that is posing a risk factor in the international markets. That is why the India's credit rating in the international markets is obviously not that high. And also beta, remember, higher the time period, higher will be the risk. Or you can say higher the time period, higher is the commitment beta that you're receiving from the other person, that he will not take back your money. So obviously you're supposed to offer him a higher interest rate. They say if you put your money in a savings bank account beta, you might get only 2.5% these days. But the minute you convert that money into a fixed deposit, the minute you convert that money into a fixed deposit beta, you might get a return of 3.5% or 4%, because you are giving a guarantee, you're giving a surety to the banker that, boss, I will not withdraw my money before the maturity of this bond. And if you are giving them a surety for a longer period, obviously guys, you will be expected to generate a higher return. So that is why longer term, duration bonds or longer securities, as such as longer term securities, will always fetch a higher return beta than short term securities. Always, irrespective of the nature of security. Yes, guys. Any other doubts beta that we have? The credit rating. The entire business performance. So here the question beta is that for all the Google Drive students, yeah, the question here is that the credit rating, is it simply based on the repayment capability? Yes, it is based on repayment capability, for which they will have to study your business performance also. What is the threat that your business product has? What are your future plans? Will you be getting into other products? Will your margins decrease? Will your margins be sustained? Will you have to put your money? Will you have to make more of capital expenditures? From where will you be raising money for those capital expenditures and all of that? A classic example beta, I would want you to track the performance of Tata Motors over the last 3 years. Their credit rating has increased amazingly, guys. So the credit, obviously beta, their performance in the electric vehicle segment is doing good, and that is why Tata Motors credit rating has increased, and that is why the borrowing cost has come down. Tata Steel, guys, another steel companies are doing very good, guys. So Tata Steel ka bhi credit rating, guys, was upgraded. That has resulted in a lower borrowing cost. You can track all of this. So it all depends on the performance of the product also. If the product is, we know that the electric, Tata Motors now has a 70% share in the electric vehicle segment as of now. Let us not forget that the market is very, very small. In that very small market, Tata Motors has a 70% share. So because their product is doing well as such, guys, there is an improvement in their credit rating. And now Tata Motors is planning to, value only their electric vehicle segment at $7 billion valuation and raise about $1 billion. That is about 8,000 crore rupees approximately. So ठीक है, all of these factors are taken into consideration for determining credit rating. ऐसा सोचो बेटा, when someone passes a comment कि बंदा बहुत अच्छा है, टाइम खराब चल रहा है, that is what happened with Tata Motors. So their longer term performances were pretty decent. People believed in their performances, but then they went through a bad phase. Okay, any other doubts, guys? Someone texted sometime back, you said that the consumer spending has declined, which has led to a fall in GDP. Then how is the inflation increasing? Okay, right now, guys, I'm not discussing economics for finance, but however, beta, there's a lot of liquidity in the market. A lot of liquidity in the market. Government has pumped in a lot of money in the market as such, guys. So when there is so much of money lying in the hands of individuals as such, guys, undoubtedly there will be an increase in there will be an inflation in the economy as such, beta. And what is more important to study, guys, is also the components of inflation. What is driving inflation? In the last 1 year, guys, there were few commodities that have increased drastically. That was because of the demand and supply constraints also. अब agricultural commodities का जो inflation है बेटा, that does not just depend on the amount of money lying in the hands of individuals, it also depends on the output. जैसे right now बेटा, it has already been estimated that there will be a drought-like situation in India. The rainfall is 10% lower than the average rainfall. So this will have an impact on agricultural output. An impact on agricultural output would in turn mean an increase in agricultural prices. Agricultural sector and natural resources, mining resources, are considered as the primary sector. ये है which gives us the raw materials. So when the prices of these raw materials increase, the prices of all other products will increase, and that causes inflation. In the last 1 year, steel prices have increased, copper prices have increased, all commodities have increased, guys. Agricultural commodities prices have also increased. That has driven inflation in the last 1 year. Something which even the government cannot do anything about. So it is important beta that you understand these aspects as well also. International commodities agar increase ho rahe beta, we will have little control over the prices of them. So that is one important point that you're supposed to know. Also, guys, now that you've spoken about this, let us not forget almost 50% people depend on agriculture in India. It supports almost 50% of the population, though the share of agriculture in the overall GDP is only around 18% now, 14 to 18%. But still it supports 50%. So if the agricultural output is less, beta, we are also talking about a lower spending power of this 50% individuals. A lower spending power of this 50% individuals, guys, would have an impact on the overall economic activity again. A circular effect, which can have a little impact on the markets. That is why stock markets better actively track agricultural output as well. Okay, any other questions? Was ज़्यादा उसमें जा रहे हैं? Any other questions, guys, so far? We are not getting done with the class now. Any other questions, guys? Should we take a break at this point? Neki or Puch. Huh. Yes, guys, do you guys need a break? We will be taking a break of 5 minutes, guys, and then come back. Exactly a break of 5 minutes, beta. 5 minutes break, and then we'll be resuming it again. Okay? The Google Drive students, your class will continue. I'm just pausing the video for 5 minutes. तुम्हारे लिए कुछ फर्क नहीं पड़ेगा. All others, beta, please take a break of 5 minutes. Same meeting. ठीक है? Yes, beta. Let us resume the class. Now, we were talking about the risk-free return, guys, and the risk premium, which will determine the required rate of return of any security. Okay. I told you that the risk-free return before the break, guys, the risk-free return is nothing but the return that you are generating from a government security. Government security ka bhi beta return will depend upon the duration. I have shown you a document beta where the return of different duration government securities beta differ. If you want that document, you can always text. I'll share that document, guys. That is nothing but the document of an insurance company, guys. They have to track returns. So I was showing you the same document. अभी एक नोट लिखो बेटा, all of you, just for our understanding so that we remember it. The credit rating of a company cannot be better than the credit rating of the government in the international market. Cannot be better than the credit rating. Cannot be better than the credit rating of the government in the international market. In the international market. As an say Reliance Industries. Reliance Industries credit worthiness. Credit worthiness. Even if better than Government of India. GOI matlab Government of India, guys. Reliance Industries credit worthiness, even if better than Government of India, will be restricted at the same level as GOI. Same level as the Government of India. Now, the only reason, guys, we have spoken about so much of economics is because of the doubts that you guys have asked. Itna detail economics and all is not relevant. It is only for your understanding कि ultimately कैसे affect होता है. जैसे someone keeps asking better. The many people, guys, who keep asking, sir, why can't the government simply increase their spending to revive the economic activity? See, guys, if the government has to spend more to revive the economic activity, they will have to borrow more. It is not that they can merely print money, guys, and circulate in the market. If they are borrowing money, guys, from the domestic market only, they are guys, squeezing liquidity from the market. That will not work. So if they are borrowing money as such, guys, from the international markets, if they are borrowing left, right, and center, guys, remember the credit worthiness of the Indian government can go for a toss, and that will increase borrowing rates. And if that is increasing the government rate as such, guys, security rate, then obviously better the overall interest rates in the economy will increase, and that in turn will have an impact on the economic activity. So guys, simply increasing government spending by borrowing money also is not the solution, because that will have an impact on the interest rates also. Sub related, guys, everything is related. I've started also teaching economics of finance at CA intermediate level. So it's only useful, guys. All of this you've learned at CA Intermediate Economics of Finance. तो ये समझ में आ गया बेटा. Credit rating of a company cannot be better than the credit rating of the government, guys, in the international market. Any other point? हाँ, ये भी लिखो, guys. Another note, बेटा. The value of a security in the short run. The value of the security in the short run. The value of the security, guys, in the short run is also dependent on the demand and supply factors. Is also dependent on the demand and supply factors. Demand and supply factors, guys. Higher demand results in a higher price. Higher demand results in a higher price. Higher demand results in a higher price. Just say, beta, there was one stock, guys, I remember a couple of years back, someone called me and someone said, Rahul, buy this stock. It is now trading at the levels of 200 rupees. It is a tip from one of the biggest investors. This stock will increase left, right, center. So on the day, beta, you received this information, the stock was already trading at 240 rupees. You notice, beta, that the stock increased to 300 rupees. So, this will force, people will start thinking that the tip is actually correct, and they will start buying the stock, guys. This stock went to a level of 390 rupees. After that, beta, there were only sellers. There were no buyers in that stock, only sellers. And the share price, beta, came down to levels of 10 rupees. There is actually so much. There are certain stocks, beta, that are driven by operators. हम लोग इसको बोलते हैं operators. Imagine, guys, that you are only buying and selling. You're creating this artificial demand, guys, for the stock. You are spreading rumors, beta. You start accumulating the stock at low prices first. After a certain stage, beta, you will only artificially try to increase the price. And after a stage, beta, you will spread the rumors that the share price is going to increase. So at that point, beta, when people are buying the stock, you start offloading. You start selling your shares as such, guys. You start selling your shares, beta, altogether. And then, guys, the retail investors money goes for a toss. So हाँ, ऐसे stocks भी बहुत है बेटा. So be careful, guys, when you invest in the markets. We will discuss about the fundamentals also, better. Fundamentals also. There was one more company, guys. तो क्या होता है बेटा, every company listed entity as such बेटा will have an investors meet in which the investors can ask question to the board of directors guys regarding the performance of the company, regarding the factors that are going to affect the performance of the company on a later date. So they asked as to why this company is not declaring dividend. The response given by the company was, we are generating a very good return, so there are a lot of reinvestment opportunities, that is why we are not declaring dividend. You know guys, what was the return on equity generated? The return on equity that this company generated was 1.5%. How in the world beta is 1.5% a very good reinvestment opportunity? Matlab, even if you declare the entire money beta to the shareholders, they will bloody, even if they put that money guys in a short-term government security, they will generate 4%. How in the world is 1.5% a very good reinvestment opportunity? God alone knows, but this was the response given. A majority of the money that was generated by this company beta was given as loans to related parties, to their own group companies. A lot of fishy transactions. So it is very important beta that you also read, that you go through the financials of the company before you blindly invest in any company. Before we blindly invest in any company as such, better it is better. See, last 1 year guys, all the share prices have increased. There's a lot of liquidity driven increase also in the market, because a lot of money is chasing the markets. A lot of people guys have invested money in the markets. Obviously, when so many people better put their money in the markets, the demand increases for stocks, and that also pushes up the price. So that does not mean guys that the prices can always sustain at high levels for a very long period. Over a longer period guys, it is the fundamentals of a company that will determine the value. Over a longer period, let us not forget beta, fundamentals will determine the value. अब तुम decide करो बेटा whether you are a speculator or whether you are a trader or whether you are an investor. A speculator or trader beta, you are just playing on the demand and supply factors here. You are not worried about the fundamental performance of the company over a longer period. But if you are someone who wants to remain invested for a longer period, who does not want to take a very high amount of risk as such guys, if you are someone who is not gambling in the markets, then yes guys, you are supposed to go by the fundamentals of an organization, the ability of the organization to generate good amount of cash flows over a longer period. What is their product, who are their management, are the people who are running the company, you know guys, good enough to improve the performance of the company. All of these factors will matter a lot. We have a separate chapter called as security analysis, in which I will be talking about fundamental analysis. I will be also talking about technical analysis. Technical analysis is like chart reading. So we will be talking about these factors again. ये भी लिख लो बेटा. Over a longer period, the fundamentals of a company will determine the value. Will determine the value of a company. Will determine the value of a company. Over a longer period, better, the fundamentals of a company will determine the value of a company. Will determine the value of a company. Guys, हाँ, ये बहुत सारे बेटा, if you see these Instagram posts and everything, you will see बेटा, I am sure you must have come across this. There was this one stock guys in which Warren Buffett had invested. Disney बेटा, he in 1960s की बात कर रहा हूँ बेटा, 60s or 70s. He invested $4 million and he exited. He sold his stock beta at $6 million. That is, he made a return of 50% as such guys, and he exited. If he would have held that stock beta, it would have been worth only $14 billion today. $14 billion. That is $14,000 million would have been the value of that 4 million stock which he sold at $6 million. But then can you really compare like that? What is more important is also to check better as to how did he invest the remaining $6 million? What is the return that is generated on the remaining $6 million over a longer period? All of that is important guys. See, at that point of time, he believed that he's generated a good return and he exited. He thought that, okay, this is fetching a good value. There is some other place in which he can generate a better return, and that is why he wants to exit this. So ye expectations of these people regarding different securities beta will always be different. That is why transactions occur on a market. Okay, I've been telling you this. Okay, sir, understood. Longer period, fundamentals of a company will determine the value of a company. Over a shorter period, it is the demand and supply constraints that determine the value of a company. Perfect, guys. Now, better write the siding: real return and nominal return. Real return and nominal return. All of you better write the siding: real return and nominal return. I just told you better a couple of minutes back that the interest rates prevailing in an economy guys will not only compensate for inflation, they are also supposed to actually help you in increasing your wealth. They're also supposed to actually help you better in increasing you generating a positive return, that is after nullifying the impact of inflation. So guys, the interest rates, listen better, do not copy, I'll give you time to copy. The interest rates prevailing better, the interest rates prevailing compensate for inflation and should also help in क्या बेटा, increasing wealth. They should also help in increasing wealth, whatever are the interest rates prevailing. The word nominal indicates beta including the impact of inflation. Real matlab excluding the impact of inflation. So what we say beta is the interest rates prevailing are termed as nominal rates. The interest rates prevailing beta are termed as nominal rates. Sir, why are they termed as nominal rates? Because they compensate for both. You do not get a compensation separately for inflation, guys. If you go to a banker beta and say what is the fixed deposit rate, will he tell you, sir, 4% plus whatever is the interest rate prevailing? Nahi beta. See, I know that there are certain inflation adjusted bonds where the interest rates prevailing on that bond will depend on the inflation rate prevailing, but that is also, guys, nothing but nominal return. No, whatever returns that you generate, guys, in the market are all nominal returns. If you would want to know your real return, you will have to remove the impact of inflation. The interest rates prevailing are termed as nominal rates. Better to compute real return, we have to remove the impact of inflation. To compute real return, beta, we have to remove the impact of inflation. अब ये कैसे करते हैं सर? Listen guys carefully, just as an example, nothing to do with interest rates better, but as an example, imagine guys, imagine better that last year there were 1000 units sold, price was 20 rupees. So total value beta is 20,000. Total value beta is 20,000. In the current year beta there are 1100 units sold at a price of 21 rupees. Total value beta is 1100 into 21, 23,100. Yes beta, one more important thing, I expect all of you to use a calculator with a GT option, grand total option. This is the calculator that I use. You can use any basic 12 function calculator, but then remember beta, please ensure that you have a GT option in it. Even without grand total beta, you can use M plus, I know, but then if you have grand total guys, it is good. So whatever calculator that you're using beta, GT रहना चाहिए. अगर नहीं है तो beta, go to your office, replace your calculator with someone else's. If you see the percentage increase in volume beta here, if you see the percentage increase in volume, 1000 units but have increased to 1100 units, correct? Yes sir. So there's a 10% increase in volume beta. If you look at the percentage increase in price, percentage increase in price, class to record ho raha hai na? Yes. Percentage increase in price beta, it is 21 minus 20 divided by 20. There's a 5% increase in price. If you look at the overall increase, percentage increase in overall value beta, 23,100 minus 20,000 divided by 20,000. 15.5%. इसको हम लोग बोलते हैं बेटा रियल इंक्रीज. This becomes your inflation rate. Why did I give this example, guys? Is just to help you in establishing a relationship. Sir, why are you doing this? Because beta, what you've learned at CA foundation level beta is different, okay? So what you've learned at CA foundation level beta is slightly different. वहाँ पे beta, if you remember, if you recall, if you are my foundation student, I must have told you beta that this is not the appropriate way of relating nominal return with real return and inflation rate. So if you were to establish a relation beta, here you write 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. 1 plus 15.5%. You can check this relation, guys. Please understand better. At foundation level, what we learn is, at foundation level, we simply write, do you recall this beta? किसी को याद है foundation level पे क्या लिखते हैं? If you remember, please answer now. Anyone, guys? Correct. Smart personality beta. हाँ. Nominal rate is equal to real rate plus inflation rate. This is what we learn at foundation level. All of this is Fisher's effect. But please understand, guys, when I refer to CA final, this is the relation that I will be talking about. I will write 1 plus nominal rate is equal to 1 plus real rate into 1 plus because this is the actual relation, guys. You can see the effect of compounding. I cannot write 10% plus 5% beta is equal to 15.5%. I cannot write 10% plus 5% beta is equal to 15.5%. It is 1.1 into 1.05. That would effectively give me 15.5%. The 5% increase in price is not just on the 1000 units, it is also on the 1100 units. It is also on 1100 units. So here, guys, when I want to establish a return beta, so for interest rates, guys, for interest rates, the wording that we are going to use beta is, the wording beta that we are going to use is 1 plus nominal interest rate, 1 plus nominal interest rate would be equal to 1 plus 1 plus real interest rate into 1 plus inflation rate. So now beta, let us understand, guys. What if your 1 year government bond rate beta, 1 year government bond rate is, say for example, 3.86%, just as an example beta. अब ये बोलो, guys, will this be nominal return or will this be real return? बच्चों, will this be nominal return or will this be real return, guys? 1 year government bond rate, if I tell you, is 3.86%, will this be nominal rate or real return? Correct? Mehul Singhvi says it is. Mehul say, guys, कोई direct message मत करो बेटा, चलेगा. You can talk to everyone. Mehul, can you tell me why is it real return? Mehul? Mehul, can you tell me why is it real return? Okay. It is nominal because I told you. Correct, beta. It is nominal, guys. It is not real return, beta. Whatever interest rates are prevailing in the market, guys, are always nominal returns. They are not real returns. Whatever interest rates that prevail in the market, guys, are all nominal returns and not real returns at all, as such, guys. So this would be better. You do not get a separate compensation for inflation, guys. This is nominal interest rate. Now let me say beta that your inflation rate is, say we know beta that the inflation rate is around 6% now. So 6%. Can you all compute beta and tell me? Can you all compute beta and tell me as to what is the real return that we are generating here? What is the real return beta that we are generating here? I would write 1 plus 0.0386, that is 1 plus nominal interest rate, is equal to 1 plus real interest rate. This is what I want to compute. Inflation rate is 6%. .979811 is equal to 1 plus real return, real interest rate. Real interest rate is equal to 0.979811 minus 1, negative 0.0202 approximately, negative 2.02% real interest rate. Yes, beta, I told you this in the beginning also, guys. At present, the real returns are negative because the inflation rate is high and the interest rates are less. But then over a longer period, guys, as the inflation eases, everyone will start generating a positive return. If the inflation rate is not easing beta for the next say at least 3 quarters, RBI takes action beta only if they fail to put the inflation within the targeted range for a continuous period of 3 quarters. ये पूरे technicals है beta. This is because of monetary policy committee का जो agreement है between the government and RBI. So over a longer period, the inflation has to ease. If the inflation is not easing, guys, the RBI has to increase interest rates over a longer period, not in the shorter period. I hope you've all understood, guys, as to what is this real interest rate. Are we all clear about it? Is there any doubt in this computation? Any doubt in this computation, guys? No doubts? Let us all copy this, guys. All of you better please copy this. All of you guys please copy this. सब लोग कॉपी करो बेटा ये रियल रेट एंड नॉमिनल रिटर्न. Here guys example. ये हो गया ना सबका कॉपी करना. This example guys. Are you all done with this? Write this better now. If you're all done with this, I'll move on to the next example. Chalo guys, I'm assuming that you're all done with this. Now that you're done with this, beta, next example will be with risk adjusted rate. Whatever we did in the previous example, beta, was basically our क्या था ये risk free rate में था beta. What if you're computing for risk adjusted rate, guys? Say for example, guys, Reliance Industries का beta से long term bond is fetching you, just as an example, beta, say fetching you 7.6% return, okay? And so this obviously beta would be the risk free rate or risk adjusted rate. This is risk adjusted rate. Matlab this includes your risk premium also beta. This is the risk adjusted rate. This includes risk premium. This is not Government of India security, guys. This is the bond or debenture of Reliance Industries. So obviously that will incorporate risk. When you're computing the risk adjusted rate beta for Reliance Industries, I'll change the example beta. Say, what if I use Bharti Airtel? Because you might tell me, sir, why Reliance Industries? Say if I tell you Bharti Airtel beta and say 7.6%, this is you will obviously be expecting a return higher than the return that you are generating from Government of India security, because Bharti Airtel beta will have some amount of default risk. I'm not telling you there'll be huge amount of default risk, but there'll be some amount of default risk beta in the as far as Bharti Airtel is concerned. And say guys, your inflation, guys, inflation rate beta over a longer period, say beta, is some 5% as an example, guys. So can you compute real return here beta? Can you compute real return? Can we all compute real return, guys, here? Whatever is the risk adjusted rate beta, this automatically beta would be your nominal rate. Whatever is the risk adjusted rate beta, this automatically beta would be the nominal rate. All of you beta compute real return using this example. Answer. $1.076 divided by 1.045 is 1.02476. This is equal to 1 plus real return, which in turn beta would mean that your real return is equal to 0.02476, which would be equal to 2.476%. The real return that you are generating here beta will be equal to 2.476%. Please make a note of this also, guys, quickly. All of you beta copy this example also. Kuch nahi hai beta, just relation between nominal return, real return and inflation rate. Relation between nominal return, real return and inflation rate, guys. We might be using this beta at few places. That is why I'm explaining it now. Yes, guys. If you're done with that beta, you can say yes, so that I know, guys, whether you're able to copy in the time allotted or not. Okay beta, so all of you are already done with it. Yes, guys. I would be starting off with the basics of time value of money, guys, in the next class. Yes, we are winding up the session today here only at this point only. Normally, guys, first class that I take, had it been offline class, by the time we actually start the class, it will be 6:45, 7 o'clock. The first class is of 2 hours only. But guys, from tomorrow we will be taking class for the entire 3 hours, beta, properly for the entire 3 hours. Ensure beta that you come you start the session at the correct whether or not beta you guys join the session by 6:30, I will be starting off the session. So ensure beta that you start on time. We would be doing all the basics of time value of money again, guys. We would be discussing concepts of reinvestment. We would be discussing concepts of effective yield, what will happen if you were to discount cash flows better with different compounding periods, all of that over the next 2 days. And then we will start better with bond valuation. I would be starting with security valuation. We will do bond valuation, and then beta we will be moving on to equity shares. The reason I do beta these topics first beta is because it builds your understanding of time value of money even more. The entire bond valuation, guys, and equity share valuation that we will be doing is mere application, guys, of time value of money. So in case if you are good with time value of money, we will be understanding those topics matlab guys amazingly well. So ठीक है बेटा, that's it for now. Bye guys, I'll see you guys in the next session. Okay, ensure that you log in on time. Bye bye guys.